Hello, welcome back to the show. So in today's video, I'll be talking about why I'm bullish on these two stocks. So in today's video, we'll be covering a few things. We'll be covering the two stocks that I'm bullish on right now, some recession indicators that are appearing in the markets already, as well as some questions that you guys have left me in the comment section below. So let me talk a bit about my investment philosophy first. So these three criteria, they need to be met whenever I'm trying to pick all my different stocks. So I want stocks that are high quality with strong fundamentals as well as high predictability. And so for every single one of my stocks that I hold and every single stock that is in my portfolio and my watch list, I want them to fulfill all these three criteria over here. So the first stock that I'm bullish on is none other than S&P Global. So S&P Global, they recently just reported earnings and they beat both on the EPS as well as the revenue. So this is S&P Global's earnings. So S&P Global, they increased revenue by 8%. They increased their net income by 10% and they increased their EPS by 12% year on year as compared to last year. And they are also announcing that they will be divesting their mobility division in the S&P Global main business over here. So I think this is a good decision by management because S&P Global, the core businesses include your market intelligence in the form of your data as well as your commodity insights portion, as well as your ratings business. The mobility side was a very cyclical and a very small portion of the entire business that diluted the quality of the business. So overall, I think this is a very good decision by management. Let's see if it turns out to be a shareholder friendly one in the future. So for S&P Global over here, there are multiple tailwinds and this is one of them. So one of it is this debt maturity wall over here. In 2028, the debt maturity wall is going to peak out. So from 2025 this year all the way until 2028, you can expect the ratings portion of the business to basically just keep growing at 10-12% every single year all the way till then, and then after that it will start tapering off. So for S&P Global over here, there are some secular trends and some secular tailwinds for this business. So one of it is just general GDP growth. When there's more GDP growth, then more companies will want to basically invest more money into businesses. And when they invest more money, then they need more debt. And that leads to more ratings. The other portion is simply just their pricing power. So they basically increased their pricing power by quite a substantial amount from 2015 all the way until 2022. So in 2015, it was around 6.15 basis points, and then now it's around 7.45 basis points. And if you are to multiply the difference by the trillions of dollars that is being sort of like loaned in the debt market, there's an extremely big difference in terms of S&P Global's total earnings over here. And there is also the recurring aspect of the business. So when more debt is being refinanced, when more debt is being issued, all of them, they need to be rated by S&P Global. The next tailwind is simply just your emerging markets and international credit markets, as well as your China market as well, which is growing quite steadily as well as the Chinese economy is emerging from a recession that they had for the past 2 years or so. So this is why a company must get S&P Global's rating. So if you don't get it rated, let's say you borrow $100 million, you have to pay an interest of let's say 9%, compared to another company that gets it rated, borrows $100 million and basically get a BB plus rating, which will equate to around 6.5% interest rate. And if you're to look into the numbers itself, the company on the left has to pay 90 million interest for 10 years, whereas the company on the right has to pay 67.5 million of interest in 10 years. So if let's say the company on the right pays S&P Global 0.075%, which is $0.075 million, the company on the right is still saving a lot more money than the company on the left. So overall, because of the sheer amount of debt that is being borrowed by all these different companies, it is often better for them to just pay S&P Global to get it rated so that they can sell the debt at a better price. So this is S&P Global's valuation over here. So the price to free cash flow metric over here for S&P Global has been down since the IHS market merger. So currently it's trading at around a 27 times price to free cash flow. I think for a quality business like S&P Global, it is definitely reasonable to pay around a 27 times price to free cash flow. Hopefully it gets to around 25 times price to earnings as well. That will be an incredible buying opportunity for a quality business like S&P Global. Next stock is United Health. So United Health is a stock that was hit very hard post earnings. They were down around 22% in one day. And ever since that 22% down day, it is still continually going down. And now I believe it's 30% down from pre-earnings itself. So for United Health over here, they had sort of like an earnings disaster. So the management, they lowered their EPS guidance by around 10 to 12%, and the stock price actually dropped around 30% from the day before earnings already. So I see it as sort of like an overreaction, and they cited that it was because of increased United Health Medicare Advantage costs, which will lead to more MLR, leading to less margins for United Health itself. So this is what management and what an analyst said about United Health's business. So United Health is facing a lot higher utilization costs simply because of the controversy that they've had over the past few months, and simply because United Health is approving a lot more of the claims that people are putting through because of the scrutiny on the business over here. So this is clearly a one-time thing. Once this Luigi story, once this CEO death story just basically passes by, United Health will definitely be able to turn this one around for sure. So this analyst over here, he also stated that the company is taking action to improve results and considers the issue related to Optum and elevated medical costs highly addressable as we look ahead to 2026. So overall, management is still quite bullish on the company itself, and they think it's a one-time event, and they've been quite reliable over these past few years or so. So for United Health over here, they've cited that it is due to increased Medicare Advantage claims, and the government has also made some form of changes to the Medicare Advantage prices over here. So they've increased the Medicare prices by around 5.6%. So they're paying out more money to all your different insurance companies to tackle all this higher cost. And this was after Q1 ended. So overall, Q1 could be just a blip in United Health's earnings. Let's see where this one goes. And if you have to look at United Health valuation right now, it is currently trading at around a 17 times price to earnings. And historically, United Health has traded at around a 20 times price to earnings. So assuming a 20 times price to earning and assuming a 10% EPS growth, which is more than reasonable considering that they are aiming around a 13 to 16% EPS growth in the future, this company is going to give you around a 15% CAGR, which is a 2x in 5 years. So I think for a 2x in 5 years, this is definitely reasonable for the business right now. I think it is undervalued, and that's why I added to United Health recently. And if you're to look on the right over here, this is a company that has seen revenue growth almost every single quarter since around '08 over here. So quality business, quality fundamentals. Let's see how this one plays out in 5, 10 years or so. So next portion over here, I'll be talking about some of the recession indicators that have shown up already. So on the left over here, you have the Atlanta Fed GDP number. The Atlanta Fed GDP, they recently just revised the GDP downwards again. And then on the right, you have the consumer confidence. Consumer confidence is almost at a level of the COVID pandemic already. So we're seeing some form of consumer pulling back as well as the GDP revisions downwards, which could lead to some form of a recession. So the GDP over here is made up of a few components. So you have your government spending, your consumption, your investments, as well as your net exports. So let's talk about the government spending portion first. The government spending portion is lowering down because Doge is trying to cut government spending, and when government spending comes down, that will lead to some form of negative reversions in your GDP over here. Next portion is your consumption. So your consumption portion is clearly weakening right now. You saw it in the consumer confidence. Consumer confidence are going down, and when consumer confidence goes down, then your consumption could go down as well, which will hurt GDP. Next one is investments. For the investment portion, Trump is trying to bring in all the investments into the US, so that could be a positive revision in GDP over here. And the last one is net exports. So net exports is export minus import. And currently, we're seeing a lot of imports over here, which will lead to a negative revision in GDP because all these different companies, they're trying to front run all the tariffs that could be placed on all your different countries 90 days from now. And this will hurt GDP as well. So overall, GDP is going to be quite negative in Q1. That is what Atlanta Fed is basically trying to forecast because of all these components over here. Your government spending going down, your consumer spending going down, you have imports skyrocketing as well, which will hurt GDP over time. And so the GDP could scare the markets, and the GDP will likely scare the markets if it comes out super negative in Q1. Let's see if it plays out that way. So this is what to do when it comes to recession indicators over here. So my opinion is that recession indicators will always blink, but staying invested is always the approach. Buy when valuation makes sense because the markets will often bottom before the worst is over. Last portion over here, I'll be talking about some questions that you guys have left me as well as some comments that I find interesting in the comment section over here. So the first comment over here is from someone that was talking about Coke. So I talked about Coke being a buy and hold forever business in basically anyone's portfolio. And this guy said over here that I disagree with Coke. Revenue is flat last 10 years. 10-year free cash flow CAGR, negative 6%. Price to earnings, 29 times. Is very high for a company that does not grow at all. Coke's long-term debt more than doubled in the last 10 years. I do not see how Coke can grow for the next 5 years. Hard pass for me. So my personal opinion is that Coke is a stable 8% every single year. So what they do best is they increase their EPS by around 5% almost every single year, and you add on the dividends, which is around 3%. That is easily at 8% without any multiple expansion over here already. So Coke is a company that has latent pricing power. Basically what it means is they can increase their prices, but they just haven't done so yet. And that is why their revenue has been flat over the past few years. And for Coke, I think the business model is basically unbreakable at this point. So for Coke over here, they're sort of like a franchise business. What they do is they just license out and then they have contracts with all your different bottling companies, and they do nothing. All they do is they use their brand name and they collect some sort of licensing fees as well as franchise fees from all these different bottling companies over here. So overall, the business model is extremely capital light, and it's a business that is basically unbreakable at this point. And that's why I think for me, Coke, if you're looking for an 8% every single year, catching it at the right price at around a 22 to 24 times earnings could give you alpha above the markets over the long term if there's some form of multiple expansion over there. Next portion that he talked about, LVMH is very attractive at current PE of 22 times, lowest in 6 years, 10-year CAGR revenue 9%, free cash flow 15%, debt to equity 0.6. LVMH share will have more room to decline if global economy worsen, but the value now is highly attractive. So I do agree with LVMH. I think it is attractive now, but it is not attractive enough yet for me to enter into this stock. Why? Because the company simply is too big. It is too big to grow a lot more than what it did over the past few years. So over the past 10 years, LVMH is not as big as it is today. Currently, it is a company that is simply just too big to continue growing. So if you have to look at Apple, for example, Apple can't grow because they are too big already, and there's nothing else that they can do other than just buying back their shares every single year. Same thing for LVMH over here. They're too big, and the only way for them to grow is through acquisitions, and acquisitions are normally not extremely predictable. So for LVMH over here, I think going back to 9% revenue growth might not be possible, maybe a 5 to 6%. And the story for LVMH now is simply just people getting richer, as well as the China recovery story. The China recovery story portion is still weakening because the Chinese consumer, they're pulling back on all your different luxury brands. They're buying their own luxury products in the country itself. And so for me, LVMH over here has always been a company that is traded at a premium, and currently, even today, I think it is still trading at a premium as compared to its fair value price. I would like to add to LVMH around $90. That is where I see myself getting a starter position into LVMH. And that is where I see myself getting an alpha above the market at the right price over there. So hopefully it gets there. It's around 10% down from here. Let's see where this one goes. Next portion he talked about is Hermes. So Hermes is even better, although it is overvalued now at P of 59 times. ROIC is 25%, revenue CAGR 12%, free cash flow 15%, very minimal debt. Hermes is almost resistant proof share, just like Ferrari. Their customers are the elite rich and will not be affected by recession, the top 1%. How many people in this world do you think can afford a 65,000 Hermes Birkin bag? Are Hermes and LVMH prone to trends? No, they're not like Nike, Lululemon. They have vintage products, and it is exclusivity as well as luxury. I don't disagree with whatever he said. In fact, I want to own luxury companies simply because the brand name is so powerful that people will still continue buying them. It makes them feel good, it makes people feel good, and that's why people will buy luxuries over your Nike or Lululemon and so on. So for me, I think Hermes is a quality business. It is one notch above LVMH simply because the brand is so much more respected as compared to LVMH. So for LVMH, what they do is they target more of the masses. They want to appeal to people. They want to sell more volumes. Whereas for Hermes, they target the top 1% of the top 1%, which is what I love because they have pricing power. They can double their prices next year and people will still buy their products. But for LVMH, they can't do that. And so if you're to compare LVMH and Hermes, I think Hermes is the high quality business, but for Hermes, the problem has always been the valuation. It has never traded at below a 35 times earnings. And for a company that is trading at 59 times earnings now growing at 12%, I think it is not very justifiable for you to pay such a high multiple. And so overall, to sum up this content over here, I think Coke at around 24 times earnings would be a lot better as compared to LVMH at 22 times earnings or Hermes at 59 times earnings. But let's see if Coke trades there again. Coke was trading there at the start of this year, which was when I made this video. Let's see where this one goes over here. Next comment over here, he says, I think Google is not cheap on a price to free cash flow basis. It takes time for the capex to hit the P&L statement through depreciation. I prefer Amazon as well as Meta. So he's not wrong. Google is facing a lot of free cash flow suppression simply because of the capex. So it's a similar story for Amazon, it's a similar story for Meta, it's a similar story for Microsoft as well. All their price to free cash flow metrics are all suppressed. They're all highly elevated simply because the free cash flow is made up of your operating cash flow and your capex. So all these companies over here, what they're doing is they're upping the capex, and when that happens, what happens is your free cash flow, you'll be suppressed as well. So I do agree that Google is not cheap on a price to free cash flow basis, but if you were to look at the price to earnings itself, the company is trading at a historical low valuation over here. And yes, it takes time for the capex to hit the P&L statement, but overall, if these companies over here like Google, for example, like Amazon, they can improve their ROIC over the next few years or so, then I don't think this capex is a problem. In fact, Google has been increasing their ROIC over the past few years with all this capex already. So for me, I think Google, it is one of the best buys right now if you were to just take into account both the valuation as well as the quality of the business. But yes, Amazon is likely a higher quality business than Google, which is why I own Amazon as well. But for Meta over here, I disagree because it is too concentrated in advertising. They only have one thing going for them, which is advertising. Google have multiple business models. They have their Google Cloud, they have the Google Search, they have Google YouTube as well, and they have subscription as well. So overall, I think Google is much more diversified. Meta is a lot more concentrated, but of course, Google is facing some sort of existential threat right now, which is making their moat a lot weaker than others. But in the long term, I think Google will win and Google will do well. I hope you guys have found this one useful, and please invest safe.